Hey guys, this is Josh, and welcome to another episode of Fundamental Finance and Investing. In this episode, I'm just going to go over quickly how to evaluate a company. I'm going to use 3 different websites to do it to get the numbers that you need, and then I've just created a really simple spreadsheet to save yourself doing the mathematics, and I'll put a link below the video in the description on how to get a hold of the spreadsheet if you want to use it yourself. It's pretty simple, so not a whole lot of work that goes into it. So let's start here. First website I'm going to use here is the Wall Street Journal, and today here's a spreadsheet. I'm just going to do Facebook as an example. So let's just say for this example, you've done all your research into Facebook, you understand the company, you know that it's got some, intrinsic characteristics that make it give it a competitive advantage over its competitors. You're happy with the management team, and now you're up to evaluating the company. So what we'll do is I always like to start with Wall Street Journal because it gives you a really quick overview of the numbers and if they're growing. So let's go Facebook. Let's try that once more. Sorry about my slow computer. So I always like to just, you can scroll down below here and you can have a basic look at, sales and revenue. You can see it's going up year after year after year. And that's what you want to see because it's growing. And to get the exact percentages that you're looking at, you can go across to the income statement here. And as you can see, from 2016 through to 2020, the company has been growing its sales very nicely. You've also got net income here, which is another one. So from I believe that's 10 billion of net income we're looking at. Yep, so that's 10,000 million. So 10 billion up to 29 billion over the last 5 years. So I'll start putting these numbers into the spreadsheet straight away. So we want to fill out the grey sections, and then all the green sections will fix themselves up. So sales and revenue. The first year from sales and revenue is 27,638. And the final year for sales and revenue is 85,965. 85,965. And then the number of years. So 2016 through to 2020, even though there's 5 years of results there, there's 4 years of growth. So 2017, 2018, 2019, 2020, that's 4 years of growth. So that's the number we use there. So over how many years? It's 4 years. And there you can see the compound annual growth rate for sales and revenue is 33%. So we'll continue on with that with earnings per share. So here we have earnings per share basic. So first year is 3.49. So here we'll go 3.49. Last year is 10.09, 10.09, and that's over 4 years also. So the compound annual growth rate for earnings per share has been 30%. Now to get the equity, we go across to the balance sheet and scroll to the bottom, liability shareholders equity, and you've got total equity down the bottom here. So as you can see, very nice growth trend there as well. So first year is 59,194. 59,194. The last year is 128,290. So 128,290. And that's over 4 years also. And that's 21%. So as you can see, these numbers are quite great. Facebook's a pretty good financial company. So next we'll go operating cash flow. So operating cash flow is on the cash flow statement here. And here you've got net operating cash flow. Very good growth trend there as well. So that's what you really want to see. You want to see 10% year on year growth. So very good start. So first year is 16,108. 16,108. The final year is 38,747. 38747, and that is over 4 years as well. So that's 25. So average of all is 27.27. Now for the growth rate that you want to use down here, you have a few options. You can use the average of all. You could use any of these. I'm going to show you now how to get the analyst estimate. Or I like to be more conservative, noting that Facebook's like a pretty big tech company, and it's got potentially a lot of growth in the future. So you got to kind of come up with your own growth rate here. History is a great, to look back in the rear vision mirror is a great way to look forward. Clearly they've grown well for the last 5 years. You can even go back 10 years if you want and see how consistent they are. But they have been fairly consistently high. So you could probably get away with using above a 20% number here, but I usually like to be conservative and not go over 20%. But tech is one of those industries where it can be quite explosive for a period of time. But yeah, we'll continue on. I'm going to find the analyst estimates for the next 5 years. So for that, I use Yahoo Finance. And to find it here, you just go Facebook in the stock lookup, click on that, and you go to analysis. And then when you scroll down from analysis, you've got growth estimates. So the next 5 years per annum, the analysts estimate 21.5. So we put that over here, and you can, not 51, that's 21. And you can see that's fairly in line, pretty close. 6% is a lot of difference, but like equity and the analyst estimates are fairly similar. I believe even Warren Buffett says equity is one of the best metrics to use to kind of take into account how you expect the company to grow in the future. So the fact that that's pretty close to equity, I'm pretty happy to use that. But just because of my conservative nature, I'm going to use 20% because even 20% a year compound annual growth for a company is huge. So I'll stick with that for now. Next up, I'm going to find the trailing 12 months earnings per share. So to find that, I will go back to the Wall Street Journal, and I'll just click back on overview here because a number of the things come up here. So price to earnings rate, earnings per share trailing 12 months has been $10.10. So I'll pop that into the trailing 12 months earnings per share here, $10.10. The future PE. So for the future PE, I like to use the average. There's two ways you can do this. You can use double the growth rate. So that would be a PE of 40. But I like to see what the average has been over the last 5 years. And to find that, I go to MSN Money and quote search. We'll look up Facebook again. Across to analysis again. And this information is on the price ratio tab. So as you can see here, you've got price to earnings ratio over the last 5 years. Its high has been 32 and its low has been 17.32. Now, there's a few ways you can look at this. You can be conservative and use a low. You could average the two out, or knowing that Facebook has got to a price to earnings ratio of 32.9 before, I believe also at the moment, so their PE ratio at the moment is 25.5 for the trailing 12 months. So if you're really bullish on the company and knowing that you probably, this style of investing, you want to hold for as long as you can for the long term. That's why we do this. So I guess you could say, I'm going to sell this in a bull market if I ever sell it. And we know that it's been to 32.9 before. So I'm going to use that in the equation. That's one way to look at it. Or you could be, I don't want to be as bullish. I'll use a low, or you can find the average. In this instance, I find for myself, 25 is a pretty average number in between those two. So I'm just going to use a trailing 12 months. Facebook have been, like as we've seen the numbers, they've been growing pretty well of recently. So I'm pretty confident that they'll keep that up. But, and especially a very bull market like right now, the fact that PE ratio isn't even at the max, like I'm pretty comfortable using that number. So the projected number of years, if I had more than 5 years data right now, I would probably go out to 10 years. Like if I did 10 years research into the past and had all these numbers from the past 10 years, I would probably project out 10. But for this, I've only got 5 years of research. I'm going to project out 5 years, and we'll go from there. Margin of safety, I always use 50%. So what that means is, it just means that if I value the company to be $100, I'm not going to buy it until it's $50, because that gives me a margin of safety on any errors I've made in my judgments, on any potential calculation errors. You shouldn't be making calculation errors, but at the end of the day, we are human, and, researching a company isn't it isn't a zero-sum game. It's not exactly like mathematics is an exact answer. When you're researching a company, a lot comes down to what you believe, what analysts believe, and it comes down to the opinion you form around the company. And that's why we go through the 4 filters. And this is the last filter of a company. You should already, by the time you get to this point, you've wanted to done your research to know that you understand the company. You know that the company has moats that protect it from its competition, and you want to know that the management are, taking a long-term view on the company. They're running the company for you, the shareholder, not for their paychecks. So a margin of safety of 50% just gives you a lot of confidence in your decision. If you're buying it at that, there's a big price disparity between price and value. So realistically, whatever you put here as your minimum acceptable rate of return, you're probably going to outperform that because you're giving yourself a 50% discount to start with. So yeah, minimum acceptable rate of return, I like 15%, because if I'm making 15% compound annual growth rate, then I'm doubling my money every 5 years. And the wonders of compound growth. If I started with $100, after 5 years I'm going to have $200. After 10 years I'm going to have $400, because that 200 now doubles. So yeah, gotta love compound growth. All right, so yeah, this makes it so much easier because there's a lot of calculation that goes into these things. So basically, this spits out your number at the end. Your margin of safety price, so present value per share, according to the numbers that we've just input, is $318 per share. Now, what is Facebook currently worth? Facebook's currently worth $257, but according to the numbers that we've input, $318 is a comfortable value for the company. Now, because of the margin of safety that, it's in the words, margin of safety, you're creating yourself a safety on the price that you're buying. You don't want to buy the company to $159. You can always change your margin of safety if you're comfortable to take more risk. So if we only went a 30% margin of safety, the price is now $223. And as you can see, that's getting very close to that price. So if you're very, very bullish on Facebook over the next 5 to 10 years, you probably be more comfortable paying that price. But I like 50% because I want to know pretty damn confidently that I'm going to make money and I'm not going to lose money. So yeah, that's the end of that. Hopefully that makes sense to you. If you have any questions, chuck them down below and I will get back to them all. And yeah, if you've gotten any value out of this video, make sure you like and hit the subscribe button so you get future videos. And like I said before, I will make sure that I put a link in the description below on how you can get a hold of this as well. So for now, subscribe to the video. Click on the other videos if you want to watch some other ones that go through other different topics. But yeah, I'll see you in the next video. Cheers, guys.